Would you like to receive payments every month, as if you own several buildings, shopping centers, or hotels, but without dealing with tenants, repairs, or mortgages? Today I'm going to reveal to you the 8 REIT stocks or real estate investment trusts that pay me rent every month, even though I don't own a single property in my name. After months of research, analyzing data, reading reports, and following the moves of major investors, I've compiled a select list of 8 stocks that generate consistent, solid, and predictable income. And the best part, some pay dividends every month, not every quarter, but every month. In this video, I'll explain why I chose these shares, how they work, and how you too can start receiving those rents in your bank account. Ready to put real estate to work for you? Let's get started. First, it is essential to understand what a REIT is and what its advantages are. A REIT, or Real Estate Investment Trust, is basically a company that owns, operates, or finances income-generating real estate. But the most interesting thing is that, by law, REITs must distribute at least 90% of their taxable profits to shareholders in the form of dividends. That means that when you buy shares in a REIT, you indirectly own a portion of properties like shopping malls, office buildings, hospitals, warehouses, apartments, and hotels, and you acquire the right to collect the dividends provided by their rents. While most companies distribute dividends quarterly, there are REITs that pay monthly dividends, allowing investors to enjoy frequent income, ideal for supplementing their salary, reinvesting, or simply having a passive income that comes on a recurring basis. So, with a REIT, you can be a landlord without dealing with tenants, without seeking bank financing, or without worrying about repairs or management. Now, on to the 8 stocks that pay me rent every month. 1. Stag Industrial. This is a REIT specializing in industrial properties, such as warehouses and distribution centers. It has more than 550 buildings in 41 U.S. states, many of which are leased to e-commerce giants like Amazon. This makes it incredibly relevant in a world where online shopping is almost a daily occurrence. The interesting thing about Stag is that it doesn't go directly to large cities like New York or Los Angeles, but rather focuses on secondary markets, such as Kansas City or Memphis. There it finds better opportunities and returns. It also signs long-term contracts with stable tenants, which gives its revenues a lot of predictability. Stag has been paying monthly dividends since 2011 and offers an attractive yield, typically between 4% and 5%. But the best thing about this fund is its resilience. Even in crises or recessions, demand for logistics centers remains strong because online commerce never stops. Another key factor is its management team, which is constantly selling less profitable assets and buying strategic properties to improve revenue. This helps the portfolio remain profitable over the long term. If you find this video helpful, please give it a like and subscribe to the channel so you don't miss our next content. 2. Agree Realty. This REIT owns over 1,900 properties leased to giants like Walmart, Dollar General, AutoZone, and Tractor Supply. Businesses that keep operating even in a recession because they sell things people need all the time. The great thing about Agree Realty is that it pays dividends every month, offering a yield of between 4% and 5%. Furthermore, it boasts one of the highest occupancy rates in the sector, hovering around 99%. Something few can claim. This means it has almost no vacant premises and is always collecting rent. Another thing I like is their purchasing style. They don't just go around buying properties willy-nilly. They're super selective. They prefer fewer properties, but ones that are well located and have very solvent tenants. This has allowed them to maintain a very healthy balance sheet, with little debt, which is key to weathering difficult times. This is one of those REITs that prioritizes quality over quantity, perfect for those looking for passive income without the hassle. 3. EPR Properties. This company is one of the most unusual in the market, as while others focus on offices or warehouses, EPR focuses on entertainment, recreation, and education. Its portfolio includes movie theaters, amusement parks, golf courses, private schools, and even ski resorts. Basically, it invests in experiences that people enjoy and that can't be easily replaced with digital technology. An interesting idea, right? EPR pays dividends every month with a return that typically ranges between 6% and 8%. Now, be careful. Being so dependent on entertainment, it's more vulnerable in times of crisis because people tend to cut back on entertainment spending. Even so, EPR has proven it can withstand blows, having survived the pandemic when entertainment centers like movie theaters closed, restructured its debt, and continues to expand its portfolio. An interesting fact is that EPR is no longer as dependent on movie theaters as it once was. They've gone from representing 40% of its revenue to nearly 30%. Furthermore, because it focuses on unique and differentiated properties, it can negotiate lucrative deals and maintain high margins. 4. LTC Properties. Let's now look at a REIT that's fully involved in the healthcare sector, particularly in senior living and skilled nursing facilities. It has around 200 properties spread across the United States, and the interesting thing here is that it has an advantage. The population is aging rapidly, so demand for these services continues to grow. LTC pays dividends every month with a yield of around 6.3%, which is quite good. Additionally, it combines rental income and mortgage loans, giving it an added layer of diversification. Something to keep in mind is that, although the healthcare sector is heavily regulated, LTC has performed very well by working with solid tenants and well-secured contracts. Another point to note is that LTC has a fairly conservative strategy. It manages moderate debt levels and makes acquisitions gradually. This means it may not grow as quickly as others, but it makes up for it with stability and a consistent payment history that makes it very popular with retail investors like you and me. 5. Gladstone Commercial Corporation. It's a REIT that invests in industrial and office properties across the U.S., focusing primarily on secondary markets. Instead of New York or San Francisco, it focuses on places like Ohio, Texas, and Florida. It has about 130 properties leased long-term under net leases, meaning the tenants cover many of the operating expenses, meaning less headaches for Gladstone and therefore its investors. One of the most striking things is that it has been paying monthly dividends for over 15 years without interruption. Its dividend yield typically ranges between 8% and 9%. Although it should be noted that its exposure to the office sector can be a risk, especially now with so much remote work since 2020. Despite this, Gladstone has managed to maintain an occupancy rate of over 95%, which speaks volumes for its management. Furthermore, they have an active policy of refinancing their debt to keep costs under control, and they're extremely transparent with investors, which generates a lot of confidence in the market. 6. Chadam Lodging Trust. In sixth place is this company specializing in hotel properties. If you've ever heard of hotels like Marriott or Hilton, Chadam probably has something to do with it, as it invests in properties from these big names. It has more than 40 hotels across the U.S., giving it a fairly diversified portfolio. Chadam pays monthly dividends, and its dividend yield is typically between 5% and 6%. Its business model is based on acquiring and managing hotels in strategic markets, so its stability depends heavily on tourism and demand in those locations. One of Chadam's strengths is that it specializes in mid-range and high-end hotels, which gives it a degree of resilience against market fluctuations. Furthermore, the company has proven to be quite adaptable, even in times of economic uncertainty. Let's not forget that the hotel sector has also seen a recovery over the past 4 years with the increase in post-pandemic travel, which is driving this REIT's earnings. 7. Essential Properties Realty Trust. This American company specializes in net lease properties, much like Realty Income or Agree Realty, but somewhat younger and more aggressive in its growth. It has more than 1,800 properties across the U.S., leased to tenants in sectors such as restaurants, gyms, gas stations, medical centers, and retail stores. What makes EPRT interesting is its focus on long-term contracts with annual rent escalation clauses, which helps protect against inflation. It also pays dividends with a 3.5% to 5% yield and has shown steady growth since its IPO in 2018. A useful fact is that EPRT maintains a very diversified portfolio. No tenant represents more than 4% of its revenue, which reduces risks. It also boasts an occupancy rate of nearly 99%, which speaks volumes about the demand for its properties. And although it's smaller than other giants in the sector, its aggressive expansion strategy makes it a player to watch in the REIT world. 8. Realty income. Finally, a classic we've seen in other videos on the channel. It's nicknamed the monthly dividend company for a reason. It's paid dividends every month since 1969. It's one of the most popular REITs in the world and owns over 13,000 properties in the US, Puerto Rico, the UK, and Spain, mostly under long-term leases with high-profile companies like Walgreens, 7-Eleven, and FedEx. The interesting thing about Realty income is that it's diversified across multiple sectors: retail, industrial, and even agricultural. Its contracts are typically triple net, meaning tenants cover taxes, insurance, and maintenance, thus reducing risk. It also has an impressive track record of increasing its dividend, more than 120 increases since its founding. This makes it a favorite for long-term investors looking for consistent, growing income. Realty income is also part of the S&P 500, the world's leading stock market index, giving it an extra level of credibility and stability. Its dividend yield typically ranges between 5% and 6%, making it very competitive with bonds or savings accounts. Many people believe that to live off their income, you need to be a millionaire or inherit property. But today I showed you that with intelligence, patience, and the right tools, you can build a solid source of passive income through the stock market without worrying about broken pipes, delinquent tenants, or property taxes. If you want to get started, research each of these companies, consult with your financial advisor, and design a plan tailored to your needs. As we've seen, you don't need properties to collect rent. These actions can provide you with returns similar to those of buying properties outright, but more conveniently. Do you know of any other real estate stocks that you find interesting or that pay dividends every month? Tell us in the comments. If you enjoyed today's content, remember to give it a like and subscribe to the channel so you don't miss our next videos. See you later.